welcome back to the Don and Gino Real Estate and Finance Show right here in your hometown station, AM 1220 KHTS.
And remember, our goal is always to guide you to personal and financial wellness.
Well, you're going to be really glad you stuck in with the Don and Gino Real Estate and Finance Show for the second half. Always second half. Did you see the last week's Saints game? I was there. That was exciting stuff. And this is going to be even more exciting because we have Bill Dallas, CEO of Skyline Homes. Yes, the Skyline Homes that Gino and I rave about all the time because we love helping you with the dream of home ownership. We have the absolute best team in the world because everybody here cares, and so do we. And that's why you need to reach out to us at SantaClaritaHomeLoan.com. SantaClaritaHomeLoan.com. Everybody on our team's an absolute professional, or they wouldn't be in our team. We close on time every time. That's right, unless there's some property issue. But we close on time, and we'll help you find the right program for you. Again, SantaClaritaHomeLoan.com. And now back to Bill Dallas, who's going to, again, we're sharing why homeownership's so great and where the industry is. And he would know he's actually created more of what our industry is all about than anyone else. And we were just talking about the values of home ownership, and we were talking about it's one of the best investment tools. We talk about on our show, Gino, that the numbers run that homeowner's net worth is 46 times greater than someone who rents.
And the other one we always talk about is, and as landlords, we always say, you're paying a mortgage, my mortgage, right? So thank you for your service, because ultimately that's what happens.
As a investor.
As an investor, when we purchase a property, what we're looking for is the rent from tenants to debt service our property. Hopefully it gives you a little bit of profit, but if you're able to hold it, like we were just talking about, for let's say 10 years, 15 years, 20 years, that's when you start to see cash flow as a real estate investor. But all that time you were providing housing for people to rent. So the reality is, for me, real estate's been great. I've done very well with it. But yeah, there was a dip, and it was hard. And we were just talking about during the break that you got to have reserves, and you got to be prepared for that.
Yeah, I think the thing that we've learned as lenders overall, well, if you chart this right, people look back at what happened, and you sort of blame. There's a whole lot of blame. We need to change this. The banks screwed up, and then mortgage people did this, and realtors put people into houses. Basically, when you think about it, and the Treasury puts out a report that you would have thought that this was a 1930s event, right? That we had 50%, 70%, because in the 30s you had almost 70% of people in default, right, at its height. Well, so what would you guess was the percentage of default?
Well, most would probably think at least half. But it was
right?
maybe what, 9% or
12 or
something?
10%?
It was 8% default, all in. 30, 60, 90, 120, bankruptcy, foreclosure. So think about on the converse. 92% of people paid, survived, and went through it. What happened to them? Their house went down in value. And everybody's sitting at home right now listening, right? What are they experiencing? Their home's back to value. They're above water. Almost every home in America right now.
Paying down their principal.
I think so what have we learned? Right, I think a couple things. One, you have to survive. Mortgage is cyclical. Every asset class is.
Yep.
But understand what the drivers are, right? And know that. And then I think you can help manage it. We were talking about the two cardinal rules are you buy when you don't have to buy and you sell when you don't have to sell. Consumers do just the opposite of that. And so first, understand that. Second, understand that it's cyclical. Right. So you have to survive a dip. So you have to have some reserve,
yeah,
right?
We talked about that
and
with our borrowers.
As lenders, what do we ask for? We keep asking borrowers for reserves, and they keep complaining that we ask about it.
Right.
Well, we ask about it because if you don't have it, we're just trying to protect you.
So the thing that's interesting, right, we talk about the blame of why it happened and all of that, but the thing that I tell people, everybody says adjustable rate mortgages, negative amortization, 100% financing, and I'm like, that's all baloney. You know why it happened? It's because people lost their jobs, because people stopped having an income. So I don't care if your mortgage is $5 a month. If you're making zero, you can't pay it. Well, so that was one of the things. What was their unemployment rate? That's something to look at.
Yeah, default's always the same, right? Default, you got really two things happening in lending. I miss a payment, And then what happens if I do? The severity of how much do I lose? The great news about owning real estate in an owner-occupied environment, which we traffic in, right? We're not non-owner flippers,
No.
right? We don't specialize in that. We are great at providing housing to people who want to live in a home. There's all the laws in California, 580B of the Civil Code, 580. I mean, you live in a non-judicial foreclosure state.
Yep.
Basically, there's very little, if any, risk on an owner-occupied purchase, right, at all. And I think what happens is that, think about it. We provide all of your loan. So every other asset you buy, you got to have cash. Right? So you go buy stocks, unless you buy it on margin, which most people don't. You got to actually, I want to buy $1,000 stock, buy Amazon, I got to have $1,000. Real estate, how much you got to have? Zero of your own money. So you can take, I mean, we always said it's the wonder drug, opium, right? Other people's money, right? Where you're using us at Skyline, the bank, to finance your asset. Who gets all the appreciation? Who gets all the tax deductions? Who gets all of that? Right? You do, the consumer.
Well, I love that, and you just hit the nail on the head where you talked about it earlier about that whole renting versus purchasing, and I was talking about how some of the media spins it. Well, it's cheaper. It'll save you, on average, $300 a month in rent, not counting anything, just saying, and then you can put that in the stock market. They're not going to do it. I'm sorry, none of you are going to do it. I'm not going to do it. If you did, where would you do it and how to do it? You don't know how to.
Is Starbucks a savings account?
Exactly.
No.
Yeah, that's
just
where
spend
it's
the money.
go.
We just spend the money.
Right. And they're not including that your rent's going to go up. They're not including that you're paying down your principal, and they're not including appreciation, which happens over time, even with dips over time. So that's why it's such a great investment.
Right. So look, so it's probably not popular to say, but we say it all the time, that it's a forced savings account.
It is.
You know, with amortization the way it is, as long as you don't have an interest-only loan, you are being forced to save $400 to $500 a month. You would not save, or maybe $1,000.
Well,
that you would not save if you weren't paying a mortgage.
And
payment.
I see more of our loan officers doing more presentations about principal reduction and about a 15-year loan, a 20-year loan, a loan that increases amortization. I mean, think about it. If you made one extra principal payment annually, right, your loan pays off in 17, 18, 19 years, depending upon when you make it.
Right.
Just one extra. So the amount of savings that you can now plow into, because you think of equity, right? Equity can come in two ways. Comes in reducing the principal and the value going up. I mean, it's a miracle.
Well, I mean, if you look at now, and here we've been working a lot with reverse mortgages as far as, you know, a financial planning tool, not as a tool of last resort, but as a financial planning tool. So what you do is you spend 30, 40 years building equity so that you can now take it back out and invest it and use it where you need it. And Dennis was just doing the math on this, and they're saying that you can actually have twice as much net worth if you utilize that strategy, because now you get to use that equity again. You get to use it twice.
Well, and I think probably for us, right, we'll talk about two customers going forward, right? And the stuck in the middle is the boomer. But you've got this millennial on the left who, well, I call them, I don't like the millennial and I don't like, aged boomers, right, or different. I like to talk about the consumer as mass non-affluent and affluent, right? M&A and A. And a mass non-affluent, under $100,000 in income, under $100,000 in assets, right? Typical millennial or a first-time home buyer.
Right, absolutely.
An asset buyer, a person with affluence has assets, right? They have other assets. There's two different strategies there, right? And what you're hoping is that when you start as a millennial, right, or as a first-timer, you then morph yourself into assets. What are you supposed to do in your asset class? You're supposed to have blended, don't have all of your assets into one asset class. And what happens is real estate people have a tendency to plow it all in there. Take your equity out, have an annuity, buy a rental, buy some stocks, do some things. You're trying to blend your risks so that every asset class has a January effect, which is eventually what they used to call in stocks was eventually every stock comes back into favor because the price is so low that it looks like a bargain.
Yeah.
And you think, well, that's true with housing or anything else that we do. And I think from forced savings to buying homes to all those things that we do. I mean, now you can see why we love it.
Right.
I mean, I've spent my life.
You can't get out of it.
I
We
love
can't get out of it.
I love this business because of what it does for friends, family, consumers, community, America. I mean, it basically is the fabric that keeps together the Bill of Rights, the Constitution, because it is the only thing, I think, that's tax favored that matters. And we can talk a little bit about Trump's, all the tax changes and some of those
We'll dive
things.
in that on the next segment. Again, I love that Bill Dallas, CEO of Skyline Home Loans, is talking about how housing actually keeps America together. And we'll be right back in the final segment. Some good stuff coming up. We will talk about that tax reform and why home ownership is so good for you. We'll be right back.